Ladies and gentlemen, thank you for standing by and welcome to the Centuria Capital Group HY21 Results Conference Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question and answer session. To ask a question during the session, you will need to press star one on your telephone. Please be advised that today's conference is being recorded. And now I'd like to hand the conference over to your first speaker today, Mr. John McBain, Joint CEO. Thank you. Please go ahead.
Good morning and thank you for joining us. I'm John McBain, Joint Chief Executive of Centuria Capital, and together with my fellow Joint Chief Executive Jason Hulich and our Chief Financial Officer Simon Holt, we'll take you through Centuria's half year 21 results presentation. Starting on slide 4, our real estate portfolio significantly expanded. Group assets under management increased 16% to 10.2 billion through the half, underpinned by a record 1.5 billion worth of direct real estate transactions. Across both Australia and New Zealand, particularly within the industrial and healthcare sectors. Throughout the period, listed real estate AUM increased 16% to 4.8 billion, unlisted increasing 7% to 4.5 billion. Our Joint CEO, Jason Hulich, will provide further detail regarding what's been a record year for his property and funds management teams. Moving to slide 5, this larger platform generated stronger returns for security holders. Along with growing AUM, we've delivered half-year operating earnings per security of 6.2 cents. As the period unfolded, we experienced the impacts of COVID beginning to unwind, allowing greater certainty. Accordingly, we've upgraded HY21 distribution guidance to 10.0 cents and reaffirmed our HY21 operating earnings guidance range of 11.5 to 12.5 cents. Testament to the strength of the group performance, we're also pleased to report 12-month total security holder return of 22%, outperforming the S&P ASX 200 at 1.4 and the 200 REITS accumulation index of negative 4.6. I'm also pleased to report the strength of our development pipeline, which has 1.6 billion worth of property either under construction or to be developed. Turning to slide 6, Centuria has delivered a strong performance despite the backdrop of global pandemic. We achieved this by delivering on our dual strategy of corporate acquisitions married with direct real estate transactions, with the former now actively providing additional performance. Operating businesses acquired over the past 3 years are contributing strongly, with AUM growth over the half as follows: Centuria Industrial REIT increasing by 50%, Centuria Healthcare by 29%, and our New Zealand business increasing by 24%. Also pleased to announce that during the half, Centuria had its GICS code reclassified to diversified real estate. Slide 7 illustrates how our corporate dual strategy underpinned our 33% compound annual growth rate in AUM, 2017 to 2020. This includes the corporate acquisition of 360 Capital's industrial platform, which we transformed into the ASX 200 listed Centuria Industrial REIT, the 63% Heatley Limited investment, transformed now into Centuria Healthcare, and the full acquisition of Augusta Capital, enabling Centuria to expand into New Zealand. Slide 8 elaborates how these 3 M&A deals performed through the half. CIP has 2.4 billion of assets across 5 industrial subsectors, totaling 59 high-quality assets. Centuria Healthcare's AUM increased to 0.9 billion, including several acquisitions for the newly launched open-ended fund. Across the pond, New Zealand team secured several landmark assets for 2 new unlisted funds, including the NZ 178 million Visy glass manufacturing facility. Again, Jason will provide a detailed update on these funds. I will now hand you over to our Chief Financial Officer, Simon Holt, to present the financial results for the group.
Thanks, John. Slide 10 shows our earnings and distribution for the period. And it's my pleasure to report the group has delivered a half-year 2021 statutory net profit after tax of $41.4 million, with an operating net profit after tax of $34 million. Operating earnings of 6.2 cents per security was delivered, along with distributions paid for the period of 4.5 cents per stapled security. Distributions were underpinned by recurring revenues accounting for 83% of total group revenues. As John mentioned earlier, we are very pleased to announce an upgraded distribution guidance of 10 cents for the year, up from the previously announced 9 cents and the initial HY21 guidance in August 2020 of 8.5 cents. We have also reaffirmed our operating earnings guidance of 11.5 to 12.5 cents. This was also upgraded through the FY21 period from the range of 10.5 to 11.5 cents. It is important to note that our EPS over the last couple of years has remained consistent. This is in line with our expectations regarding the implementation of the then new revenue accounting standard, which has impacted the timing of performance fees. It's pleasing to note that the operating EPS excluding performance fees has continued to increase year on year over that period. This is as a result of a relentless focus by the business to grow revenue and improve margins. Moving to slide 11, which outlines the key components of our earnings. During the half, a 17% increase in profits attributable to our property funds management segment was underpinned by record real estate acquisitions, as well as the increasing benefits of operating with a larger real estate funds management platform. As mentioned earlier, recurring revenues accounted for 83% of total revenues. The group's total revenue profile has continued to transition towards increased contributions from recurring revenues. However, our half-year 21 performance fee income of $13.6 million was recognised during the period and was in line with expected fund expiry dates across the group's unlisted real estate division. It is also important to note that a further $22.3 million of unrecognised performance fees remains latent within our unlisted portfolio. As an external fund manager, Centuria maintains co-investment stakes in some of the funds it manages. This includes strong alignment with our listed REITs, CIP, the Office Fund, and our New Zealand APL or Asset Plus Limited. And we are the largest unit holder of each of these trusts. During FY21, the group's co-investment strategy has yielded $17.4 million in operating profit, up from $15.3 million in the previous corresponding period. The investment bond division reduced to $0.6 million and reflects lower prevailing interest rates, impacting capital guaranteed product returns. Our corporate expenses of $6.3 million increased in line with strong AUM growth, and on an annualised basis, these expenses are broadly in line with FY20 corporate expenses of $12.2 million. As previously mentioned, operating EPS of 6.2 cents recorded for the half reflects lower performance fee contribution and a change in the group's weighted average number of securities. Both factors reflect the group's shift towards a larger mix of recurring revenue streams and growth initiatives undertaken across the platform to position CNI as a leading Australasian real estate fund manager. Moving to the balance sheet. We are pleased to report that the group has maintained a strong balance sheet position, which has CNI well positioned to continue executing its growth strategy. The group's net asset value per security has continued to strengthen from $1.44 to $1.54 over the half. Along with cash reserves of $168 million, the group's net borrowings have further reduced with an operating gearing ratio of 2.4%. In addition, our interest cover ratio has increased to 7.5 times as the group benefited from reduced net borrowings as well as the lower interest rate environment. The group has also been prudent with the composition of its debt portfolio with staggered maturities on its corporate bond over the next 4 years. Finally, to our continuing environmental, social and governance initiatives on page 13. Centuria has made a concerted effort to monitor and improve our energy and water efficiencies across its real estate platform. This includes further rollout of solar panels across office and healthcare assets. In addition to our Hopner Street Bundamba development within the SIP portfolio, it is on target to be certified as one of the first 5-star Green Star as-built industrial properties in Australia. Centuria has continued its commitment to the Sydney-based special needs school St Lucy's, as well as the Tanya Dalton Foundation in New Zealand, raising more than $150,000. This was complemented by in-kind support, including volunteering work by many of our staff. The group continues to enhance its corporate governance framework through greater diversity and independence across its responsible entity boards, CPFL and CPF2L. We'll also shortly be submitting our modern slavery statement to the federal government. Finally, I'm pleased to report that the integration of our New Zealand business is ahead of schedule, with many of our back office and governance functions now embedded in our business. I'll now hand over to Jason, who'll take you through C&I's divisional highlights.
Thank you, Simon. Let me start on slide 15. As John mentioned, we significantly expanded our real estate platform over the period, growing assets under management to $9.3 billion across Australia and New Zealand. The platform is approximately split 80% in Australia, with 20% across the Tasman and New Zealand. The combined Australian-New Zealand platform collectively has a 95% exposure to the industrial, healthcare, and office real estate sectors. Decentralised office assets still comprise the largest individual sector exposure. However, industrial and healthcare are expanding quickly. The other sectors Centuria has a minor exposure to in New Zealand are large format retail, supermarkets, shopping centres, and tourism assets. The platform is almost evenly split between our listed and unlisted vehicles. On the listed front are our ASX pure play REITS, Centuria Industrial REIT, CIP, and Centuria Office REIT, COF, and our NZX listed Asset Plus Limited. On the unlisted side, we have a variety of fixed term and open-ended funds in both countries. Centuria is proud of its deep network of loyal investors across our different vehicles. It is now a key focus to grow our unlisted institutional investor base in the near to medium term. On to slide 16. It is our pleasure to report a record half in terms of asset acquisitions over the period. During HY21, acquisition activity increased to a record $1.5 billion worth of real estate secured across 24 individual assets. This is a 25% increase above our full year result from last year, which in itself was a record. These are high quality assets underpinned by strong tenant covenants. Close to half the transactions were secured on a sale and leaseback arrangement, which enables the tenant to free up capital for reinvestment into their businesses. Most of these agreements were secured on long-term leases, providing certainty of income for our vehicles. An impressive 57% of assets were transacted with triple net leases, which are our preferred lease structure. Triple net leases significantly minimise capex and maintenance costs for our funds, as these expenditures are the responsibility of the tenant. CIP transacted a record number and value of transactions throughout the half year, with $693 million invested across 9 assets. This portfolio growth helped expand the REITs WALE to 9.8 years, with an AUM of $2.4 billion. Also on the industrial front, we're in the process of launching 2 unlisted industrial funds, one in Australia and one in New Zealand, which I will touch on a little later. Both Centuria Healthcare and the 2 unlisted funds in New Zealand collectively acquired 8 healthcare assets worth $370 million. The New Zealand team is also busy progressing its $132 million development pipeline. We also divested 9 assets worth $303 million throughout the period. Moving to slide 17. As an external fund manager, Centuria is proud of its in-house asset management capabilities, which unlock value add initiatives for our investors. Additionally, our in-house team is at the coalface of tenant relations, which has been critical throughout the COVID-impacted trading period. We now manage 948 tenant customers across 216 individual assets. Our strong tenant relationships and quality tenant covenants delivered an impressive 98% rent collection rate between July and December 2020. Over the period, we leased more than 273,000 square metres of space across 117 individual deals, which is a significant feat in the current pandemic period and a sign of our deep tenant relationships and the quality of our properties. These leasing deals further supported our focus on quality tenant covenants, which is shown by the large proportion of our tenant base, which is state and federal government, listed entities and multinational corporations. All sectors within our portfolio have healthy WALE and occupancy metrics. Slide 18 highlights our significant development pipeline in both Australia and New Zealand, collectively worth 1.6 billion. Approximately half is already committed and the other half will be progressed over the short to medium term. In Australia, these projects range from value-add initiatives to improve an existing property's rental income and capital value, development of sustainable healthcare and industrial properties with both pre-let agreements as well as speculative opportunities, and finally social infrastructure development such as affordable housing and specialised homes for those living with dementia. Moving to our unlisted funds on slide 19. Collectively, Centuria has 63 unlisted single asset funds, 4 multi-asset open-ended funds, and 5 institutional mandates across Australia and New Zealand. The breadth of these unlisted funds generated 13.6 million in recognised performance fees throughout HY21, with a further 22.3 million of latent underlying performance fees. As I alluded to earlier, Centuria launched 2 unlisted funds throughout the half, with a further 2 new funds currently raising capital. In Australia, the Centuria Healthcare Property Fund launched, which is an open-ended vehicle secured by private hospitals and medical centre assets. In New Zealand, the multi-asset Augusta Property Fund launched with the NZ $55 million Anglesey Medical Centre as its seed asset. This fund was oversubscribed within 9 days. We have recently launched the Visy Penrose Fund in New Zealand, anchored by the $178 million Visy Glass manufacturing facility, as well as a fixed-term Centuria Industrial Income Fund number 1, anchored by 3 high-quality industrial assets located in Adelaide and Brisbane. Slide 20 outlines our listed ASX and NZX vehicles. Last week, CIF delivered solid results, highlighted by excellent leasing activity and rent collection, which averages around 97%. The portfolio includes 23 high-quality assets valued at 2.1 billion, with a market cap of approximately 1.1 billion. CIP also delivered its strong half-year results last week, with its portfolio expanding to 59 assets worth 2.4 billion. The ASX 200 REIT experienced a transformational period, not just through its acquisitions, but also a very strong leasing period. It has a current market cap of circa 1.7 billion. Lastly, Asset Plus continues to perform well. This REIT includes 5 assets valued at NZ 300 million. And this portfolio includes the development of the Monroe Lane office complex in Albany, Auckland, which is majority pre-let to the Auckland Council. I'd now like to pass back to John, who will talk through our corporate strategy and outlook.
Thank you, Jason. So some comments on markets and strategy. As Jason explained, Centuria is exposed to compelling industrial, healthcare and decentralised office markets. The industrial and healthcare real estate sectors experienced strong tailwinds throughout the half, which we expect will continue into FY21 and well beyond. Centuria's office portfolios are exposed, as I said, to decentralised markets. We have no exposure to Sydney CBD, which is experiencing high volatility during the COVID-affected trading period. COF's portfolio is underpinned by strong tenant covenants, and we expect this REIT to continue delivering very strong cash flows. The launch of our new funds is evidence of strong investor appetite for unlisted vehicles, and we see this appetite to continue unabated through FY21 and beyond for those seeking relatively high returns. New Zealand, like Australia, has benefited from the Go Hard early strategy for managing COVID. Subsequently, we believe the Kiwi commercial, industrial, and healthcare markets will also remain strong throughout FY21. At the core of Centuria's outlook throughout the near term is our aspiration to increase funds under management by 50%. In terms of execution of our strategy on slide 23, to summarise, we want to continue to deliver on our dual growth strategy across both Australia and New Zealand, within the industrial, healthcare and office sectors. Our half-year results illustrate a strong record for delivering on this strategy to date. With our strong balance sheet, strong distribution network, high recurring revenue, our expanded real estate platform, Centuria will continue to build out and grow our multiple fund verticals where we see attractively priced assets, and ensure we take corporate acquisition opportunities again when these are sympathetic to our existing business lines or in an asset sector we believe is sympathetic to our strategy. Before I open the door to questions, on behalf of Jason, Simon and our management team, I'd like to thank our investors for your continued support throughout this half and the preceding years. That concludes the formal presentation. I'll now hand back to the operator to commence Q&A.
Thank you very much. Ladies and gentlemen, we now begin the question and answer session. If you wish to ask a question today, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the # or # key. Once again, if you wish to ask a question, it is *1. Thank you very much. We have multiple questions in the queue. Our first question is from Mr. James Druce from CLSA. Please ask your question, James.
Yeah, hi, good morning, John and Jason. Thank you for the presentation. My first question is just around guidance, just the uptick for the DPS to 10 cents. Is that just more confidence around the macro?
Yeah, James, thanks for the question. You probably recall, and most of the listeners will recall, when we started giving guidance, we're probably at pains to make it clear to the market, and particularly your section of the market, that it's pretty difficult in the middle of a COVID-affected period to convince a lot of non-executive directors to put a really bullish guidance figure out. In fact, a lot of our peer set didn't put guidance across out. So we wanted to. It was the first time I think we've ever used a range, Simon. Is that correct? And we made it really clear that we were going to be conservative, and as the year progressed, we were going to flesh out where we thought we were. So we sort of tried to obey what we told the market.
Yep, that's clear. Just on the development pipeline on page 18, can you give a sense of the completion profile for those committed projects over the next 1 to 3 years?
Sure. So it's Jason here, James. So just looking at them, NZ Commercial, that's 2 main projects. So Albany, which is underway, and then the Auckland building, which they're just working through, trying to secure a pre-commitment on at the moment. So that's probably closer to 3 years away. The social infrastructure and tourism, New Zealand developments, that's a bit of a mix. Obviously, you've got the 2 hotel assets on balance sheet. With what's happening, I think they will probably move a bit quicker than we might have thought 6 months ago. And a big chunk of that is the Augusta share of the Lakeview project down in Queenstown, which is actually moving quite nicely through planning, but that is a long-term project that will be completed in multiple stages over sort of 7 or 8 years. Our social infrastructure developments, which are the 4 projects, the first one reached PC last month, with the next 3 all completing over the next 3 months. AU Healthcare That's a couple of projects that we're in the middle of, so they will be set over the next 24 months. And in the future pipeline, the big chunk, which is the healthcare, they are projects that will be sort of 18 to 36 months out.
Okay, and for the healthcare one, what's the what happens? What needs to happen to get that really moving?
There's two main ones there where we are in negotiations with basically an anchor tenant to take circa 50% of each, and those discussions are quite advanced.
Okay, that's very good. Thank you. And then finally, just a question on sort of the launch of the funds. Just on the funds that you have launched, when do you think you'll close those? When will they close? And are there any new launches that you're thinking about this next half, or any other initiatives that you're close to executing?
Sure. So Busy is due to close basically at the end of this month in New Zealand, and that's all on track with the equity raise. Our industrial income fund number 1, which we opened up 10 days ago, we're oversubscribed in terms of registrations of interest. Application forms are coming in thick and fast, and we'd expect to close that to the public offer very shortly. Probably what we can see in the very near term would be the continued growth of our healthcare property fund. We have had 2 raises in the last 6 months in that fund, and I would say a third is not too far away. We've got some good pipeline, and we've secured some great assets to add to that portfolio as well.
Just adding to Jason, it's probably not lost, James, that the Busy acquisition in New Zealand, to our knowledge, is the largest single retail unlisted acquisition in Australasia that we know of. And the capital raising, consequently, of 108 million Kiwi would be the largest single retail unlisted offering undertaken. And the New Zealand guys are doing a fantastic job.
Yeah, that sounds very good. And just one final question, maybe for Simon. I think you had about 7 mil of one-offs up front from your equity raise prez back in October. Can you just confirm that's come through this half, or is it the next half?
No, the majority of that comes through next half. In relation to Visy, it's all comes through this half. Second half, I should say.
Second half 21. Okay, perfect. Thank you.
Just a reminder, ladies and gentlemen, to ask a question, it is *1. Our next telephone question is from Richard Jones from JP Morgan. Please ask your question, Richard.
Oh, thanks. Just a bit of an expansion, sorry, to James's question, just on the development. Can you say how much of the committed 833 mil has been spent so far? Roughly?
On the New Zealand commercial project, obviously other than buying the land and the ex-council building in Auckland, the construction's just actually commenced recently on the Albany project. Lakeview, very little of that amount to date. It's probably been less than 10 million. Social infrastructure, those projects are finishing now within the next couple of months, and most of that has now been spent. Most of the other projects there are sitting at either just all that's been spent to date has been the land or the existing asset that will be redeveloped.
And can you just step us through how you recognised income off those projects?
Obviously, there'll be some that are development fees, and they'll just be taken on the way through. In relation to balance sheet related developments, for example, social infrastructure, it's basically a time value recognition with an amount kept till the end to clean up any issues that may have occurred in terms of profit.
Okay.
Outcome.
So percentage complete effectively. And your target on assets under management growth of 50%, have you got a time frame on when that might be met?
Yeah, it's John. Thanks, Richard. Basically, we've been growing at a compound rate of over 30% per annum for around 5 years. So what we're trying to do is now we've got 10 good verticals. We've got organic growth in 6 months of 1.5 billion. So that far exceeds what if you look at the presentation, we got 12 months at 1.2 or 1.3 is the closest. So it looks like, provided the assets are there, we can get pretty attractive organic asset growth. And we're going to stick to our dual strategy of trying to buy something. So it kind of depends the next time we get a platform that we think is right, but it could easily be done in 18 months. If provided the right platform's there. That's how we see it. And I think we're quite an attractive size. A lot of larger groups couldn't contemplate that, I don't think, easily. But we're at 10 billion. Whilst it's the largest we've ever been, it's still a relatively low number. We'd like to do much better.
And can you kind of differentiate investor demand between healthcare, industrial, and probably office?
Yeah. Look, Jason here. As you'll see, as you've seen in the last 6 months, all those acquisitions have been, industrial, healthcare, obviously the large data centre. On the retail side, if we're launching an unlisted fund, for office, it'd have to be a very long-term lease to a strong covenant. What we're working on the office side is talking with a couple of institutional partners on a potential investment into probably the secondary asset market in Sydney and Melbourne CBDs. Where we have been successful over the years is repositioning older buildings, and we do think there could be some opportunities, particularly in those CBDs, and probably in the next 6 to 9 months, where rents in those secondary assets got a bit ahead of themselves. And as they could come off, there could be opportunity there to reposition them. So we've definitely got some wholesale institutional interest to invest with us into that sector. Healthcare, industrial, huge demand. Obviously, CIP has been growing very strongly. On the unlisted side, with our Industrial Income Fund number 1, that's the first industrial fund we've given to our retail base in nearly 15 years. It's been really strongly taken up both by our direct investors and the advisor groups. It's a sector that they read a lot about, that they like, and they like to get invested through one of our unlisted vehicles. So that's been strong, and healthcare is very similar. Again, a very strong sector, longer WALEs, high quality operators, and very strong demand going forward from both investors and that advisor base as well.
Great, that's helpful. Thank you.
Once again, ladies and gentlemen, it is star 1. Our next telephone question is from Tom Boda from UBS. Please ask your question, Tom.
Thanks very much. Good morning, team. Just wanted to sort of touch on the performance fees. And sorry if I did miss the detail, but just what they related to, and equally how the 22.3 will be brought in to be recognised over coming periods, or based on your expectations.
Yeah, sure, Simon here. The 13.6 for the half is predominantly the ATP fund coming into its 2-year horizon and picking up the first of its revenue in accordance with our processes and policies around revenue recognition. There is a couple of others that have got some revenue coming through, the 203 Pack Highway and 8 Central Avenue Fund number 2, but they were pushed out in terms of being extended as funds, and so the amount that's being booked and recognised from those is a little bit less in this period, but will obviously push out the income over the next period of time. In terms of into the future, it really is now probably a fairly smooth complete exercise of the 23.5 over the next 2.5 years.
Yep, that's helpful. And then the other question I kind of had is just sort of coming back to the guidance with the DPS. Well, I guess the payout ratio is increasing in the sense that your DPS guidance is higher, but the EPS is unchanged. Just wanted to sort of understand the rationale there, given, that retained capital could be used to fund growth to some extent, and, just wanted to sort of get a sense as to what the read-through is to your capital requirements going forward.
Probably it's a two-part question. So it's John here, Tom. I think I sort of approached the answer to the corporate philosophy way before, but I just restate it. We really never. Our DPS last year was 9.7 cents after profit 12, and we really struggled to work out how we give guidance when the market would have you believe everyone's going to stay in their pajamas and no one's ever going to come back to work. We always thought we'd be able to upgrade. Now, where we upgrade to, we do look at trying to give smooth returns, Tom. I think given that we've had a lot of kerfuffle over office, which I think is going to be one of the huge turnaround re-rate, we all got it wrong stories of the next 2 or 3 years, but that's just our private internal view. You look at trying to grow things a little bit or keep things online. So we always wanted to get to 9.5, 10 cents, always. We were just cautious getting there. In terms of the top line, probably Simon, you can talk to the top line. The top line just is the top line.
I mean, that's true. I think we also, when we came through with the forecast on the earnings back in November, off the back of the capital raise, there was still some uncertainty in where things were going to land through to the end of December, and we held back the distribution at that point. I think things have become more certain as we've progressed through the last month and a half or couple of months, and it has given us more certainty in relation to earnings, but also our ability to pay out the distribution at a higher rate than we had previously forecast. I honestly, Tom, don't think you should read into anything about us paying out more capital distributions as being any impact on capital. Our ability to recycle is just as important. And I think, as Jason mentioned earlier, Visi does appear to be going well in terms of its equity raise. When we raised that capital in November, we were very uncertain at that point in time as to how much New Zealand could raise in 4 weeks. We will still have, I think, a bit more capital to deploy as a result of Visi being more successful than we may have formed that view back in November.
Yeah, I think that's a good point, Simon makes. Really, if we'd had an efficient debt raising capability at that point, we wouldn't have raised equity. We're not a group that likes raising equity capriciously.
No, that's very clear, and I suppose with the increased certainty, it does sort of push you more higher in the range of your guidance. So about maybe from your side is unchanged. Another way to look at it. Yeah,
we probably thought of actually narrowing the range, Tom, but we thought, oh God, it's so close to we could exceed it. We could be in the middle. There's still 6 months or 5 months to go.
Okay, thanks for that.
Our next telephone question is from Lauren Berry from Morgan Stanley. Please ask your question, Lauren.
Morning, guys. Just on the development pipeline, can you talk how much of that requires a balance sheet commitment for the funding and what kind of timeline that will be over?
Look, there's not a lot at this stage. At the moment, the main commitment is with the what's labelled AU social infrastructure, which are the 4 development projects that are on balance sheet at the moment. The equity component of that has been fully committed. We're just now in the final stages of the debt drawdown to finish off those projects. So that will all come back over the next 3-4 months, and they've all got takeout contracts in place. Most of the rest of it will be probably completed in funds, other than you've got the two hotel sites in New Zealand. So you've got the building in Cook Street, Auckland, which was being refurbished for a Juicy Snooze tenancy. We're working through that with Event, who are 50% owner of that business. There's about $8 or $9 million to finish off that development so that it can be so that a tenant can move in. And then you've got the project down in Queenstown, which is an agreement with Radisson for a new 5-star hotel in the north of Queenstown. So depending whether that stays on balance sheet or goes somewhere else, there would be a commitment needed there. The rest of it would probably be in the majority raised in funds, either existing funds or new funds. Centuria may invest alongside investors in those, but no decisions have been made as yet.
Great, thanks. And obviously this half was a really big one for acquisitions. How do you see the rest of the year playing out? And I guess, what's your pipeline looking for, particularly on those sale and leaseback type deals that you've been really active in?
Yeah, look. It was definitely a record 6 months. I think the transactions team is performing really well. We've got great relationships with all the agencies around Australia and New Zealand, as well as a lot of the owners. We do a lot of the deals off market, and we continue to see a lot of pipeline. We just came out of our pipeline meeting half an hour ago, and there are deals to be done there. We expect it to continue to be strong. Obviously, there's some lumpy portfolios come up, and things like Telstra Data Centre, we were fortunate enough to be the successful bidder on, which with over $400 million of value really helped us. Obviously, there's some large portfolios in the market or coming to the market at the moment, such as Blackstone. That is a $3.5 billion portfolio that we are looking at in different structures on how we could be part of that transaction. So it really comes down to being successful on some of these larger deals. But I think over the last few years, we're definitely getting more than our fair share of transactions.
Probably the other thing, Lauren,
Yep.
John, the other thing is, these larger transactions come along from time to time. But what we've noticed is there's always a lot of gatekeeping. So, for example, having special relationships with people who were tenants, for example, like Visy, is of assistance. Visy was a very good client of ours for a long time. So when something comes up in Auckland and we're a contender on the list, we're taken seriously. The other thing is when these large transactions come along, one of the gating items is FIRB. So if you're an Australian platform and you don't have a FIRB issue, you certainly go into list A. If you're another platform that has a FIRB issue, that has an offshore component to their proposed registry, you go into list B. So, we're getting to a size now that we're going to see those opportunities, and we're going to get in the potential range to do them. And if they come into firing range, they're going to be acquired if we can do it.
Great. And just last one from me. You mentioned earlier in your presentation about institutional funds being a potential source of growth. Are you talking to new institutional partners for those acquisitions, or is this more just broadening your existing relationships?
Yeah, look, it's a bit of both. So we're definitely talking to quite a few large offshore and onshore institutional investors. I think on the industrial side, I think you've seen, they've seen our success over the last few years as we've grown SIP into where it is today. We've got groups approaching us more on the value add side of industrial, which would not compete with SIP. As I mentioned, we're talking to a couple of other groups on sort of value add office opportunities. We've got the AXA Grosvenor mandate on the healthcare side of things, which I think will continue to grow as well. I think they'll be expanding existing relationships and forming some new relationships as well.
Great. Thanks, guys.
Our next telephone question is from James Druce from CLSA. Please ask your question, James.
Yeah. Hi, guys. Just one follow-up. Jason, I think you just mentioned something on the milestone IPO/trade sale. Are you sort of suggesting that could be broken up?
Look, we're looking obviously at that size. There's a lot of groups that couldn't take it out in one line. We're looking at different potential structures where it could be split up between different vehicles and different equity partners. So obviously it's early days, but our teams are doing a lot of work on it.
Okay. Thank you.
Once again, ladies and gentlemen, if you wish to ask a question, it is star one. There are no more further questions in the queue. I'd like to hand the call back to the speakers for closing remarks. Please continue.
Okay, just John again, just on behalf of our team here, thank you very much for attendance today, and in particular, thanks for the questions. We enjoy them, and it's how we learn and help communicate with the market. Look forward to talking to you all separately.
Ladies and gentlemen, that does conclude the call today. Thank you for all participating. You may all disconnect. Have a great day.